And many times you can buy at an angle and they'll keep right on going up to several angles. So use the fan angles as a scalping technique without thinking. When they hit the angle, just mechanically trade. And finally, I mentioned in the moving average section that the cycles gang up on you once in a while. And if you take the maximum elongation or the maximum amount above a moving average that the stock or commodity goes, you measure that length. And that length will be identical most of the time, at least until you get a much bigger cycle, and a much longer length one will occasionally interpose itself. But usually, if you just take a bar like this and slide it along your moving average, when it gets to the length it usually maxes out, then you look for your signal reversal bar. And as soon as you see your little signal reversal bar, that's when you sell out or go short on a very short-term chart. So here we have a maximum expectation, goes back to the moving average, maximum expectation, you see the little signal reversal bar, sell out or go short to the moving average. Here it went under the moving average, and when it got to the same maximum on the downside, we would be looking for the signal reversal bar to go long with a stop. Again, it goes up. When we hit the maximum, we can sell. And you can see too, if you were using a trailing stop for a moving average, many people wait till you hit the moving average to stop out. But a better approach might be to look at the moving average as saying, I'm in an uptrend, but use these maximums that you can go to in an uptrend and liquidate here and then wait and see what happens. So this is also a technique for exiting a good trade in a trending market. When people are just starting out on a trading career, I always recommend to them that they only stick to a couple dozen, perhaps 25 issues, and they should learn everything they can about these issues. Go back 5, 10, 20 years if they can. Look at the cycles, look at the average measured moves, look at the personality and the characteristics of the stocks, how they make bottoms, how they make tops, if they have any clearly identifiable cycles, how they relate to the economy, and try and pick a stock from each of the industrial groups, the technologies and the transportations and the precious metals and the oils, etc. So they always have something that will move no matter which way the market goes. If you do this, always try and get the very best group in the best groups in the economy and the best individual stock in that group. This way, no matter what happens to the market, no matter how it evolves over time, you will always have an active stock that you can trade, and you'll be familiar with it. You don't have to trade 20 or 30 stocks every single day to be successful, but you always need 3 or 4 good ones that are moving, and studying these things ahead of time will go a long ways towards fulfilling that. You don't want to make the mistake of reading the newspaper and seeing one stock that suddenly has a big surge one day and suddenly jumping to that new stock or another one. Wait until the stocks have some good backgrounds and have a little historical data before you jump in and start trading them and changing your habits. Stick to the things that you know and keep away from the stocks that you have not made money on. Often you will find stocks that fit your personality very well and that you make money on all the time. And there are also other stocks that you really want to trade, but every time you trade them, you're going to lose money because they have a completely different personality than yours. And you will find that every time you think it's going up, it goes down. When you identify stocks that do not treat you well, you should avoid them and stick to the ones that you've known to have made money on in the past. When trading, remember to go with the main trend, and of course in bear markets you want to be short in bear markets and not long. But know that 90% of all the people in the market are usually long-term buy and hold oriented or trading on the long side. And most of the time the market is in an uptrend. The bear market's very vicious, but they're relatively short-term, being a year to 2 years, and bull markets can last many, many years. So most of the time you're going to be trading on the long side, and most of the people are going to be trading on the long side. So you'll have a much better chance of making money by picking strong active leaders and buying the dips than trying to short all the rallies all the time and trying to pick the bear market leaders. When you do trade the bear side of the market, though, remember there's no such thing as a fundamental short. There are times when individual stocks will go down and down, eventually go bankrupt. But most of the time, the short trend in stocks will be that you're going to get 20% or so on some kind of intermediate term decline in a small bear market. So trading on the short side is clearly a trading strategy. So be certain that you're going to treat it as a trade, several days to a few weeks at most. Take a profit when you can get it. Don't expect to double and triple your money on the short side. Look for 5, 10, 15, 20% type profit objectives at most, and then get out. And always try to trade with the main trend. If you make a mistake on your entry point, you'll often get bailed out if you're with the main trend. The other thing you want to watch out for is if you trade a lot, don't stop and reverse. If you go long and you lose money, don't jump right around and go short. Often it's better to just stop yourself out and sit on the sidelines and watch and wait. It's very easy to confuse yourself as to what the direction is in the market by going long, then going short, then going long, and then going short again. You can confuse your time frames. If you trade on a 15-minute chart and start reversing a lot, you can confuse yourself as to what is the long-term weekly trend and the daily trend and the 60-minute trend. So try and go when all the time frames are going in the same direction, and don't keep jumping out and reversing your trends. Let's review now a little bit of what you should have learned in this video, at least of a basic sense. The first thing you always have to do is identify the trend. You should now be able to sit down in front of any computer screen in any kind of market and know if the trend is up or down. What is the pattern? Is it higher bottoms and higher tops for an uptrend? Is it lower lows and lower highs for a downtrend? You should be able to see the reversal signal bars that change, and you should be looking at the angles. Do they point up or down, and how steeply do they do that? But in most cases, too, before you rush to judgment of what the trend actually is, check all the time frames to make certain if you're looking at a 15-minute chart that looks particularly bullish, make certain it also looks bullish on the hourly, the daily, and the weekly. So if you're going to trade counter trend, there may be a long-term decline on a weekly chart, but there may be a counter rally of a week and a half or something for a short period of time, and it shows up on a 15-minute and the 60-minute charts. So know if you're going to trade counter trend, the average duration and what the time frame it is that trend is going to exist on. Always go back and verify where did the trend start. What was the major signal reversal bar on the weekly, the daily, and the intraday charts. Don't just start with a 5-minute chart and say the low was over here an hour ago. Make certain you know where the last low was on the 60-minute, the daily, and the weekly, so you know what the primary trends are. And make certain the angles are all pointing up or down with those trends on the various different time frames. Once you know what the trend is and you're thinking about making a trade, also figure out where your likely endpoints are. Remember, we can take a measured move. We can double the reversal bar length. We can use my natural ratio lines. We can use some circular arcs. We can look at the greatest elongations above the moving averages. And we can use some of the grid expansions to get a rough idea of how far the movement should last. And also, if we're trading an intraday chart, maybe we want to see if that pattern also exists on a weekly chart, which would give us much longer term perspectives on a daily or a weekly chart than we could see on an hourly chart. And always, before you make a trade, have your stop loss strategy figured out ahead of time. Figure out the maximum percent loss you can have on every trade, and figure out how you're going to get a stop on the books immediately so you never lose more than that amount of money. Then you can adjust it to a trailing stop once the market moves a little bit after you've made your entry point, whether it's 2 or 3 bars back, whether it's a couple of swings on a 5-minute chart, whether it's the length of a reversal bar, kind of a measured move type a stop out point, or if you're using a moving average. But the initial loss you're going to take will be the biggest only when you first enter the trade. After you're in the trade for a couple of minutes, tighten up your stop. You should be making money almost immediately if you have timed the entry point correctly. When you are making your initial entry into a trade, obviously you want to make a safe entry, but if you wait too long to make it look too safe, you'll find out you always miss the trade. There's always a certain amount of uncertainty you have when you go into a trade. The best trades always look like they're going to lose money because you're always buying at the exact point before it's really reversed. If you wait until you're absolutely guaranteed you're going to make money, it's usually almost always over. So the idea is to buy on a counter trend. If you're in an uptrend, there may be a couple of bars pullback, so you're buying into a dip. You're buying at a level where there might be an angle. It might be a higher bottom. It could be some of your natural ratio numbers, but you want to see that you're making higher bottoms. Some of the angles from the prior decline are being exceeded. The stair steps are starting to turn up. Perhaps you exceeded 50% of the last swing. And you also want to look at all your time frames. But if you do a little bit of a thought before you just jump in and make an entry point, you'll do much better than just looking at a signal reversal bar and immediately buying or selling. Now, a few final thoughts as we wrap up this video. And the first thing comes to mind is that this is about trading. And trading gives you the flexibility to trade when you want to. You don't have to trade. Just because the market opened up big and it looks very bullish, there's no reason to trade if you don't have a legitimate opinion. Wait until you've done your work and you planned out a strategy and you have a real opinion if the market's bullish or bearish and the stock that you've been following is bullish or bearish. If you haven't been following a stock, don't just jump in and trade it because they had an earnings announcement. And then make your trade and use a stop. But always have some kind of an objective thought out ahead of time before you trade. When you do make a trade, oftentimes it's going to be the wrong trade. Do not be afraid to take a loss. As soon as you recognize you're in a losing trade, take the loss. It is part of business. It does not reflect on your character or intelligence. As soon as you see you've made a mistake, get out of the way. Commissions these days are very cheap, and for the small fluctuations in the amount of the stock or futures that you're trading, it costs nothing to get in and out, and even in and out many, many times a day. So whenever you have any doubt, just get out of the market and wait until there's some kind of evidence of a turn. Likewise, it's been my experience that your biggest gains hardly ever come when there's a big market move where suddenly the Dow Jones is up $200 or $300 or $400. In the past, when I saw that big move and I bought maybe 20 stocks, I would find out at the end of the day 4 or 5 of them were up big and 2 or 3 were down on the day, and the vast majority of them were flat. And at the end of the day, I made no more than if I had just carefully culled out 2 or 3 really good stocks. The real point is, if you do the work and you make your entry points perfectly where you should go in, when you should go in, you'll do much, much better than just jumping in emotionally because the broad general market is going up. Often the big market will react to news and look like it's going to go up, and you don't really have an entry point. You're not prepared. Your stocks weren't really at a pivot. They weren't at a number. So don't make the mistake of thinking because the Dow Jones just shot up $50 that you're missing something and you have to jump in. Invariably, 20 or 30 minutes later, it's going to come right back down where you should have gotten in all along, and you're going to have a short-term loss in something that you never should have even made that trade. If you're an actual trader and you're reading the charts, don't take other people's advice. Don't start thinking about fundamentals and GDP and earnings misses and listening to people on television tell you that some Wall Street firm just recommended such and such stock. That has no bearing on what you're going to be doing. You can buy and sell any stock several times a day. You may hold it for 3 or 4 days. You may buy it long today and sell it short tomorrow. So forget about the long-term hype that the Wall Street firms are recommending for people who buy and hold forever, or they're making recommendations to help their customers move their merchandise.